Thank you for your interest in the financial planning tool. You can download the tool here and start planning your finances immediately. The following video includes a product description of the financial planning tool. Following is the detailed description of the financial planning tool. You can also navigate directly to specific chapters of interest using the chapter list on YouTube.
Just as a pilot precisely adjusts his instruments before takeoff, you can tailor your financial plan to exactly suit the needs of your company. The basic settings, for example, determine the legal form, the planning horizon in years, the corporate tax rate or the interest rate for long-term loans. Our tool makes it possible to simulate various scenarios. For example, in the pessimistic scenario, what happens if your sales fall by 20%, or personnel costs increase by 10%? To automatically calculate the additional wage costs, the legally specified Social Security rates are already stored in the tool. Other insurance rates, such as daily sickness benefit insurance, can be individually adjusted.
The tool makes it easy to record internal and external employees. The recording takes place in 3 steps. First, the workload is determined in full-time equivalents, followed by the entry of the gross salary. Finally, the system calculates the additional salary costs. We show data collection using the example of a new management member that starts full-time in October. First we record an FTE, then the monthly salary. The tool then calculates the correct annual salary. In the second example, we record a software developer with a 50% workload. First the job percentage is entered, then the gross salary based on 100%. The tool calculates the annual salary from this and automatically determines the additional salary costs.
The tool makes it possible to record revenue and variable costs, also known as costs of goods sold, appropriately for different business models. We illustrate this using 4 different business models. Let's first consider an architectural firm that estimates its revenue and has no variable costs. This is the simplest case, as only the expected revenue need to be recorded at this point. In the second example, a restaurateur calculates the expected revenue for his restaurant and plans to spend around 30% of revenue on purchasing goods. Similar to the previous case, revenue is recorded first and then the 30% variable costs. Make sure that the as % of revenue option is selected at this point. In the third example, a carpenter sells chairs he made himself. He estimates the number of chairs he wants to sell in a month. He has calculated the selling price and knows the purchasing costs, i.e. the variable costs, for the wood per chair. Make sure the per unit option is selected at this point. In the last example, a jewelry designer sells wedding rings she made herself via an external online sales platform. She estimates the quantity of rings and has calculated the selling price. Material costs for gold and gemstones are $250 per ring, while 15% of sales go to the online platform as distribution costs. Make sure that per unit is selected for material costs and as % of sales is selected for distribution costs.
In the fixed costs worksheet, you enter all costs that arise regardless of sales. The fixed costs are divided into clear main groups, according to the chart of accounts for small and medium-sized enterprises in Switzerland. The tool automatically takes the personnel costs from the personnel planning worksheet. Enter all of your company's fixed costs into the corresponding main groups. Note the red triangles below, which are helpful notes to ensure you capture all fixed costs relevant to your business.
In the Assets worksheet you can record, among other things, the purchase of machines. The automatic calculation of depreciation makes your work much easier. In April you purchase a production machine for $150,000. The depreciation is automatically calculated by the tool in accordance with the specifications of the Federal Tax Administration. The fixed assets are adjusted accordingly. If desired, you can adjust the depreciation period here. The positions in the Assets worksheet correspond to the assets side of a balance sheet. If you would like to take your company's previous financial statements into account, record all items on the assets side as the opening balance sheet here. The right side, the liabilities side, is then recorded in the liabilities worksheet.
In the liabilities worksheet you can record the financing of your company with equity or debt capital. In January you found your company with a share capital of 100,000. This remains unchanged. You get a bank loan of 200,000 and already pay back 50,000 in September. Adjust the loan amount accordingly. The interest costs are calculated automatically based on your information in the settings worksheet and are included in the income statement. The items in the financing worksheet reflect the liabilities side of the balance sheet. If you would like to take your company's previous financial statements into account, record all positions on the liabilities side as the opening balance sheet here. The left side, the assets side, is then recorded in the assets worksheet.
The income statement, also known as the profit and loss statement, reveals the economic performance of your company. The tool allows you to simulate scenarios to make strategic decisions. The income statement shows key figures such as revenue, variable costs and gross profit, as well as the fixed costs that you have recorded in the fixed costs worksheet. In addition, profitability indicators such as EBITDA or EBIT are shown, with depreciation, financial expenses and taxes being calculated automatically. Ultimately, there is a net profit or a loss. The tool also takes into account the profit and loss carried forward, which explains why no taxes are due in 2026, despite the profit achieved, as this is offset against a loss from the previous year. Use the simulation options to test the robustness of your business model. You have set a revenue decline of 10% in the pessimistic scenario in the settings worksheet. In the base scenario, we will reach break-even in 2026. Let us now simulate the pessimistic scenario and examine its impact on net profit and break-even point. The impact on the income statement is significant. The break-even point shifts to 2027 and net profits are halved compared to the base scenario.
In the cash flow and liquidity worksheet you can see, on the one hand, the sources of the cash flows and, on the other hand, whether the company can consistently meet its payment obligations. The cash flows, also known as fund flows, from operating business, investing activities and financing activities, are determined and clearly shown. Probably the most important key figure is liquidity, which is always ensured here. Use the simulation options to test the robustness of your business model. In the settings worksheet you have specified a revenue decline of 15% in the pessimistic scenario. Let's simulate the pessimistic scenario and consider its impact on liquidity. The impact is significant. In the years 2026 to 2028, liquidity could no longer be secured, which will require appropriate measures.
A company's balance sheet presents its assets and financial obligations, also known as liabilities, as well as shareholders' equity as of a specific date. The balance sheet is clearly structured and transparent, divided into assets and liabilities and shareholders' equity. An automatic check of the balance sheet takes place. You can see the automatic allocation to the statutory profit reserves here.
The break-even point shows the minimum revenue at which the break-even point is reached. This is the case when the total revenue is equal to the total costs. Our break-even analysis in this tool provides an extensive collection of valuable information. In this overview you can quickly see at what minimum revenue the break-even point is reached, and in which year this is the case. The graphic further illustrates this situation. In this section you will find further useful information that can help you with your planning. Here the break-even point is broken down in detail by individual product groups. For each product group, it is shown in detail what minimum revenue and what minimum number of units are required to reach the break-even point. You can then compare these key figures with the revenue or number of units that you are aiming for according to your planning. In this specific case, all minimum revenue and minimum number of units to reach the break-even point are achieved according to planning.
Company metrics on profitability, financing and liquidity are important because they give investors, lenders and you as an entrepreneur important insights into the financial health and stability of the company. The key figures are divided into the areas of profitability, financing, and liquidity. Also take advantage of the helpful explanations for each metric found under each of these red triangles. Check the robustness of your business model by simulating various scenarios.
All results of your previously collected data are presented in more than 30 graphics. You can easily copy these into your own documents. In the tool, the data is displayed on a monthly basis for the first 12 months from your selected start month on the left, while an annual overview of the data is presented on the right. There are more than 30 meaningful graphics available to you, the colors of which you can also adapt to your own corporate design. The tool automatically adjusts the graphics to the planning period you select. If you want to extend the planning period to 8 years, select 8 years in the Settings worksheet. The graphics are then automatically updated. If you would like to copy the graphics into your own document, you can do this simply by copying and pasting them. Alternatively, you can save the graphics and import them into your document.
Based on the data you previously collected, a company valuation will be carried out. The discounted cash flow model is most commonly used internationally for young companies such as startups. The asset-based method is often used for companies that have been on the market for a long time. Although the discounted cash flow model works perfectly in this financial planning tool, startups in particular are recommended to take a close look at this valuation method and its advantages and disadvantages. For this purpose, extensive background information is integrated here. A valuation using a model alone is not enough to determine the company value. Other important factors include management experience, technology maturity, market environment, competitive comparisons, innovation, and much more.
The dashboard presents you with a clearly structured summary of your financial plan. You will find the most important key figures clearly grouped and intuitively accessible. You can display the key figures for each of your plan years separately.